Ty Young is the CEO of Ty Young Wealth Management, which advises thousands of investors across the country on retirement strategy. And Ty, it's great to see you again. I think this is great. We're talking toward the end of the year about it's been a tough year for many investors. We've seen our portfolios not do so well. And what's your outlook, would you say, for 2023, the market landscape?
First of all, thank you for having me back. And it has been quite a year. Been very, very volatile. Markets down for the year. And I hate to say it, but we're expecting a good bit of the same next year. There's a lot of outside forces negatively affecting the market. There's wars around the world. There's hostile governments. There's our Federal Reserve continues to raise interest rates to try to get inflation under control. And it seems like the government in Washington is trying to counteract that with all the spending that they're doing there. So all those things add up to what we believe is going to be continued volatility. And for the Federal Reserve to pull off the soft landing that they're talking about, I think that's a bit ambitious to make a statement like that. We expect the market to be up for the year, but just slightly, with a lot of volatility along the way.
Yeah. Well, and it's interesting because I was listening to a commentator this week who said it's not very often we're down 2 years in a row.
Right.
That's an unusual thing to happen. So you're right. We may see an up year next year, but it doesn't mean it's going to be easy. And, and just because we divide things up into years, the market doesn't necessarily work that way. We're still going to have these same issues in January that we have now: inflation, rising interest rates, potential looming recession. So, how should they handle this? Have you changed your strategy or your advice that you give people?
It's pretty consistent. Really, it depends on you and your individual situation, your age, risk tolerance, and so forth. But really, the thing that we see when we look at portfolios that come from other places, they don't have defense. They have offense, but they don't have defense. A winning portfolio has offense and defense. Offense, obviously, to grow the portfolio, to support income either now or in the future. But it also has to have defense. You got to be in a position to be where you're protected if the stock market goes down. And if you don't have defense, then you can really get hurt in a situation where the market goes down. And goes down big. And we've had 50% corrections in the stock market over the last 100 years, 6 times, right? And mistakenly people believe that if it goes down 50% and back up 50%, they're even. Right. They're not. If it goes down 50%, you have to go back 100% to get even. The best way to deal with that is to avoid those losses in the first place. Make sure you have offense and defense in the portfolio.
So when you talk about defense, would that be a dividend paying style? What would be a defensive position in a portfolio?
For us, it's protected against market losses. There's only 3 ways to do that: FDIC insurance, like a 1-year CD as an example, treasury bonds, and then third, and our clients like this one the best, a guaranteed insurance contract called a fixed index annuity. We manage about $1 billion worth of those alone. And the way they work is you put your money in. When the stock market goes up, you get about half the gains and they lock in. But when the stock market goes down, you don't lose anything, right? And you don't have to, very importantly, you don't have to make as much on the upside if you never lose anything on the downside to earn a reasonable rate of return. We love that product. It averages about 6 to 8%. And it's a great way to shore up and get defense into a portfolio.
Oh, and that sounds like a great product for somebody that is close to retirement.
It absolutely is. Yeah. If someone's 55, 60 years old and they're heading towards retirement or already in retirement, it's a great place to be for a portion, I would say even half of the portfolio, because you still get decent returns, but you just don't go backwards with the market.
And tell me the name of that product again.
It's called a fixed index annuity.
Fixed index annuity. So that would be good for somebody closer to retirement. What kind of advice would you give for somebody, say, that's 30?
Well, some of the 30, they're very different. They have time to wait it out if the market goes down big. The overall trend of our stock market is up over a long period of time. So if it goes down big, you can buy more if you're 30 years old, because you've got 30 years probably until you need the money. So my advice would be very different because the time horizon is very different. You can be more aggressive and have a bigger portion of your portfolio at risk the younger that you are and the longer you have to recover.
Mm-hmm. Are there other ways that investors can protect their portfolio?
That's my favorite way, but you mentioned dividend stocks. Those are going to be less volatile than an EV stock, as an example, or a startup stock, or cryptocurrency, as an example. Those are crazy risky, but dividend stocks are dramatically less risky. So that's another way you can have some defense in your portfolio.
Well, and some of those energy companies are paying some pretty hefty dividends.
They are.
24%, something like that. So, that's another thing to think about as you're planning.
Absolutely. And they've done well this year, and they're in the minority for sure.
Yeah, they are. Not too many sectors that you could have made a lot of money this year.
Right.
So some final thoughts about just advice as we go into, it feels like we got to work a little more than we did 7 years ago or whatever.
Right.
What should people do? Diversify and I would think like some professional advice would be more important now than ever from somebody like you.
Without a doubt, professional advice is very, very important. And understand this: at the end of the year, professional advice is huge, and that professional advice will probably tell you that the biggest expense that you're going to have in your lifetime is taxes, probably. And so, what can you do to avoid taxes now, and what can you do to avoid taxes in the future? It's the end of the year. Have you maxed out your 401k? Have you gotten all the match? Do you have access to a Roth IRA? Do you have access to a Roth 401k? Because those are tax-free into the future. The way we're spending money as a country, taxes, most people believe, are going to be going up. So tax-free retirement assets in the future, huge. So at the end of the year, thinking about avoiding taxes now or in the future is huge, because that is our biggest expense for most investors.
Yeah, and they seem like the trend is up with taxes, especially if you're in a high tax state like I am. So, they're not really cutting it. So it is a good thing. Outside, that's really good advice. Kind of start there, lower your taxes, and then worry about. Okay, Ty, always great advice. Always makes me motivated. Great New Year's resolution. Clean up your finances and position yourself well for 2023.
Without a doubt. Thank you so much.
Thank you.